When to use a short-term loan versus a long-term loan in real estate investing. All right, so a couple of principles when we're talking about real estate investing. There are different types of real estate investing that you can do. I'm going to put them in long-term and I'm going to put them in short-term, okay? So when we're talking about short-term investings, we're talking about wholesaling. When we talk about short-term investings, we're talking about fix and flip. We're talking about land flipping. Those are the types of things we're talking about. Now, when we're talking about long terms, we're talking about long-term rentals. We're talking about nightly rentals, like a VRBO, Airbnb, those different types of things, okay? When house hacking is a live-in rental, it's the same concept there. BRRRR is a combination of both of these. We'll talk about that here in just a minute. The long-term versus short-term investment is also going to determine if you should get long-term or short-term funding. So as a rule of thumb, if the investment is going to be less than 12 months, you're going to want to get short-term funding. If the investment's going to be more than a year or 12 months plus, then you're going to want to get long-term funding. That's really what it comes down to. Now, if you're looking at a BRRRR deal, which is buy, renovate, rent, and refinance, BRRRR, you're going to do both. You're going to be getting both a short-term loan and getting a long-term loan. So let's talk about these loans for a minute. Short-term loan is a loan for less than a year. Typically it's 5-6 months, could go up to a year. This is really short-term. So in some states, when you're wholesaling, you've got to get a loan to wholesale. Other states, you can just sell the paper. So you get a loan, you pay it back within a week, make the money. That's a short-term deal. That's a week long. Fix and flip, 6 months, 8 months, 4 months, just depending upon the area. You buy it, you fix it up, you resell it. Land flipping can take up to a year, usually 6 months. You buy it, you sell it. That's all short-term financing, short-term lending. Long-term, and I will tell you with this long-term, I strongly recommend that you always get a fixed rate, a fixed interest rate, okay? And you may say, well, with a fixed interest rate, I'm going to struggle to cash flow or struggle to make money or anything else like that. Well, this is my recommendation. Do an interest only for 5 to 10 years, and then 25 to 30 or 20 to 25 year amortization. But the rate is fixed. What does that mean? It means for the first 5 to 10 years of the loan, you're paying interest only. And that gives you time to get the rents to come up. So then when you start making the principal payment, you're not going in the negative early on. So, and the reason why I can tell you that is if you look at rents over the long term, you can see rents just increase over time, okay? Rents are just constantly going up. So if we say 2021 and we come to 2016, 958 to call it 1200, it's gone up 15. Doing math in my head. Okay, so 1191 minus 991 is 200 divided by 991. Rents have gone up 20%, okay? So that extra $200 could make the difference of paying that principal over a 5-year. Now, if you look at a 10-year period, and we come back here to 20, we're like 700. So 1191 divided by, or subtract 700, oops. Subtract 700 is 491 divided by 7. I mean, that rents went up 70% in the 10-year period. So always get a fixed rate. If you're going to be losing money on some of these rentals, then do an interest only for a period of time. But it's a 30-year fixed, so the rate never changes. And then hopefully rates will come down and you can refinance, or by the time you're having to make your principal payments, your rents have increased to help cover that is the concept. Okay. Long-term rentals, I'm renting to somebody. Nightly rentals is your VRBO, and then house hacking, you're also going to get a long-term loan because you're going to move into it, finish the basement, let somebody live in it, those types of things, or rent out rooms or rent out space on where you're renting out for cars to go in your garage, those different types of things. Now with the BRRRR, I'm going to get a short-term loan just like I would in a fix and flip, and then I'm going to get a long-term loan that I'm going to do just like I would for a long-term. But the difference is with the BRRRR is I'm trying to get in with little to no money down. So the idea is I'm buying it, I'm improving the value of the property, and then I'm refinancing based upon the new value of the property to hopefully come up with as little money as possible. Whereas if I go right into a long-term rental, I may be putting 10 or 20% down. With doing the BRRRR where I fix it up and I am doing value add or adding values to the property and then refinancing it, I'm trying to come on with as little money as possible. So it really depends on what strategy you're doing. I can say when building long-term wealth, you should be looking at long-term strategies. If you're looking at short-term things, it's not something that's going to pay month in and month out, where your long-term can be paying month in and month out. And so that's something to be taken into consideration here. So the differences between short-term and long-term and what that has to do with the loans that you should be looking at and you should be getting.